Good afternoon, and thank you for joining us for an MP webinar covering ACA reporting, 2022 key updates and tips. I'm Katie Kreider, marketing specialist here at MP. For those of you joining us on a webinar for the first time, MP is a full-service human capital management company. We offer a complete suite of products and services to support organizations through the entire employee lifecycle, including recruiting, HR, payroll, benefits administration, time and attendance, and compliance assistance. We support our clients with cutting-edge technical solutions, as well as proactive, reliable service and deep HR and payroll expertise. At MP, we are wired for HR and help our clients succeed by aligning their people strategy with their business goals. I'm excited to introduce your presenter for today's program, Paul Carelis. Paul has over a decade of experience in the HR consulting space, working with businesses of all sizes and industries. Paul and his team of certified HR professionals at MP assist clients with training, compliance, and full circle HR guidance and support. Just a few housekeeping issues before we get started here today. If you would like to submit a question during the program, please use the Q&A feature at the bottom of the screen. We will be sending out the recording of the webinar later today, along with the slides. And with that, I'm going to hand the mic off to Paul.
Thank you so much. Great to speak with everybody today. Really looking forward to digging into this topic with everyone. In the age of PPP and ERTC and all of that, we've kind of all collectively forgotten about the old HR stalwart acronym of the ACA, but it's here and it's coming due. So now's the best time to kind of refresh our memory if you're a seasoned business who's used to having to do these filings every year, or if you're a new business of a certain size, or maybe you've grown to become an applicable large employer, which we'll define in a few minutes. But either way, ACA is an important regulation that we want to be mindful of and make sure we're compliant with. And it can be very daunting and very complex, but we'll do our best to break that down today. Just a quick legal disclaimer. This presentation is coming from an HR best practices perspective. I am not an attorney nor a tax advisor, so please do not construe anything we talk about today as legal advice or tax advice, but nonetheless, hope you get a lot out of today's session. So in terms of what we hope to cover and address, first we'll do a overview of the ACA. We'll talk about due dates, when stuff has to be filed, as well as discussing what potential penalties are for non-compliance. We'll go over a few of the key changes that are new this year. We'll also take a little bit of time to talk about what to do if you do get a penalty letter. It can be a scary thing. A lot of times it all amounts to nothing. So just want to talk through that in a calm way and help you understand what those are all about and how to respond. And then we'll also take a deeper dive into the ACA report. So one of the most common questions we get is, I need to approve these forms, but they're not in English. They make no sense to me. What does this all mean? So we'll do our best to address that today as well. Okay, so quick overview, especially for those who are new to ACA compliance. The law was originally signed into law in March of 2010. It's been challenged several times over the years, creating cases that rose to the level of the Supreme Court in 3 occasions. And in all 3 occasions, in 2012, 2015, and in 2021, by and large, the ACA was upheld by the Supreme Court. So unless there's a new challenge and a new angle that's more successful, the ACA is here to stay. So they did, as they launched the Affordable Care Act, they knew it was really going to change the landscape of benefits, and especially benefits offered through an employer. And the ACA not only addressed that, but also addressed some of the rules for what truly counted as coverage and what essential insurance is really needed to provide and include to be considered eligible as a plan under the ACA. So it was a gradual rollout, but some of the and by now, obviously, it is kind of fully in place. We'll talk about really the last training wheel being removed this year in a second. But among the things that are included in the Affordable Care Act are guaranteed coverage for pre-existing conditions, coverage for children up to age 26. One of the things that some people don't realize when we're going through handbooks, when we're helping clients out, ACA also created the lactation break regulations for nursing mothers. They also banned lifetime coverage limits and also provided at no out-of-pocket cost to members free preventative care screening, so annual physicals and other services that are counted as preventative care under the definitions of the ACA. They also said that when an employer offers insurance, the waiting period cannot exceed 90 days. During the Trump administration, they did roll back the individual mandate. So if you remember, there was the employer mandate and the individual mandate, which meant that subject employers needed to offer coverage to eligible employees. And then there was also the onus on employees that they needed to have coverage for themselves or face a penalty. So those penalties have been rolled back to zero. So there at this time is not an individual mandate. So if an individual does not have health insurance for themselves, they will not be penalized on their federal income taxes. That can vary by state. Some states do have individual mandates, but today we're speaking in regards to federal regulations, and as such, there is no individual mandate at this time. That actually was the onus for one of those Supreme Court challenges. The one in 2021 was that the argument was that without the individual mandate in place anymore, they use that to kind of creatively say that it should discredit the entire program. But again, that got shot down by the Supreme Court. So in terms of what is new this year, they have ticked up the penalties, both the non-offer penalty as well as the failure to provide affordable coverage penalty. So those have both increased. We'll go over those updated numbers in a moment. When I spoke about the last training wheel in terms of what they've referred to as transitional relief, as employers have gotten comfortable and gotten into compliance with the ACA, there was always this term and notion of good faith, especially when it comes to the reports and the reporting of the ACA and the filings. So the IRS had officially adopted this notion that if an employer was acting in good faith, if they were trying their best to have accurate reporting and accurate files, that would be taken into consideration and eliminate or greatly reduce any penalties for any errors on the filing. So as of this year, they're saying that good faith is officially dead. There is no more good faith. They are requiring 100% accuracy on the ACA filings going forward. Also, if you're a long-time ACA filer, you'll remember that we've always kind of stared down January in the face and been nervous heading into January that ACA forms need to get done right away. But every year they've kind of punted on it and always pushed back the due dates into March. They have now moved. It's technically in proposed state still, so the ink hasn't dried on it yet, but they have put forward a formal proposal to permanently move back the due dates. And even though it's proposed, they did officially say that for this filing year that's going on right now, that employers may use the proposed due dates. So it's pretty much a sure thing. It just is not official just yet. Before I move on, we did get a quick question that I can address that I'm not sure I do address later in the presentation. Is there a threshold for the number of employees needed to be subject to this law? So yes, it all hinges on the number of full-time equivalent employees that you have. So the way that that's calculated is a full-time employee under the ACA is defined as someone who works 30 hours per week or 130 hours per month. Anyone who meets that threshold counts as one employee. They count as a full-timer. You then have to add up the hours of anyone who is not a full-time employee. So what I mean by that is if you have two employees who work 15 hours per week, adding up to 30 hours, that would count as one. That would count as one FTE or full-time equivalent. If in the previous calendar year, your FTE count or full-time equivalent count was 50 or greater, you're subject to the Affordable Care Act. If for some reason your FTE count was below 50 in the previous calendar year, you are not subject and do not need to be in compliance with the ACA for that following calendar year. So, I've been using the term applicable large employer. I may start or sprinkle in the term ALE. That means the same thing. Basically, when we say an ALE, we're referring to someone who is subject to the employer mandate, meaning they have 50 or more FTEs. We've addressed FTE in that definition. The other one here on the screen that it's good to be familiar with is a variable hour employee. So the expectations of the Affordable Care Act are that when you hire someone, in many cases you'll know whether they're going to be treated as full-time, eligible for benefits, or if they're going to be part-time, work fewer than 30 hours per week, not be eligible for benefits, not being counted as an eligible employee for these ACA benefits and reporting. But oftentimes, especially in certain industries, retail, restaurants, and others, you may hire someone who you honestly can't ascertain what their schedule is going to look like, whether they're going to be above or below the 30 hours per week, 130 hour per month threshold. There is a separate category for those folks called variable hour. If you truly have a variable hour employee and you really don't want to abuse it, if you know someone's going to be full-time, you don't want to label them as variable hour, because what variable hour does when you legitimately have someone in that position is that you can hold off on offering them benefits really for up to a year in most cases until you're able to determine whether or not they met the hours threshold based on their schedule. So it can be very useful, but at the same time, just be sure you don't abuse that. Some other really important terms, especially when working within the ACA and your filings. There are three different periods that are taken into account with the Affordable Care Act. The first of which is the measurement or the look-back period. So the look-back or the measurement period is basically the time that you're taking into consideration to determine whether or not employees worked the necessary hours to need to be offered benefits. Many or most employers use a 12-month look-back period. You can use look-back periods. You can do the monthly measurement period where you're looking at it each month, or other measurements as well. Obviously, that's more burdensome administratively, but that leads us to the stability period. So the stability period is the period of time once you've looked at your measurement or look-back period that whoever qualified as full-time during the measurement period then needs to be offered benefits. And that period generally needs to be at least as long as your measurement period, and in some cases a little bit longer if you use a really brief one. So what I mean by that is if in our example here, if you were using a 12-month look-back period, you can then have what's called an administrative period. So that's your open enrollment time, the time that you have to take a look at the data, take a look at the hours worked, and really determine, okay, who do I need to be offering coverage to? And that's then followed up by a stability period where if you're using the 12-month look back, anyone who rose above that 30-hour per week average is then offered insurance for the next 12 months, regardless of how their hours ebb and flow throughout that following year. They remain eligible for that entire time. The one exception to that would be if someone had a permanent status change. So let's say you had someone who was full-time, and then all of a sudden, for whatever reason, maybe they're taking an additional job, or they need to reduce their schedule to care for a loved one, or are just heading towards retirement and moving to a part-time schedule. If there's a permanent change status change to them where they're going from a full-time employee to a part-time employee, it's not just a varied schedule, then that could potentially change the rules in terms of being locked in for the stability period, where they could lose their eligibility based on that status change. But by and large, if someone qualifies, then they're in that stability period for the duration. Okay, one other question before we move on. Does the employee holiday pay and vacation time count towards hours worked? Yes, so the way that another key term that's important to know, and I don't believe it's on the slides here, is how the ACA counts hours. So they say hours of service rather than hours worked. So when they say an average of 30 hours, and I apologize if I said hours worked, the ACA defines it as hours of service. So basically any paid time, whether that be actual hours worked, paid vacation, paid holiday, paid sick, those all count towards the equation of determining hours for the ACA. So it's hours of service rather than hours worked. A few more key terms before we move on to the next section. You may hear people refer to the exchange or the marketplace. So depending on where you are, that's either going to be the federal exchange or the federal marketplace at healthcare.gov, or it could be a state exchange as well. So some states decided to defer to the federal marketplace rather than building their own. Other states, I'm sitting in Massachusetts, so here in Massachusetts we have the Mass Health Connector. But really, if any employee or any individual goes to healthcare.gov, based on the information they provide and where they live, that would either continue them through the federal exchange or kick them over to their respective state exchange if there's one set up. The reason why we bring up these exchanges is because these are really where potential penalties for employers come from when it comes to the ACA. So aside from not filing your required forms with the IRS, which is its own penalties, the big heavy hitter penalties that we talk about all have to do with whether or not you're offering coverage and whether or not that coverage is affordable. That being said, there are no penalties to be had unless you have an employee, they go to one of these exchanges and they sign up for insurance, and based on their income or not being offered affordable insurance from their employer, they receive a subsidy or a discount on that coverage. So by going to the exchange, entering in their information and how they respond to that, if they then sign up for a plan either through the federal or state marketplace and qualify for a subsidy, that's what triggers penalties and penalty letters to you as the employer. And penalties are based on that. So that's important to know. So even if your coverage is not affordable, or even if you don't offer it to everyone that you should be, technically speaking, you wouldn't necessarily be penalized for that unless you had an employee go to the exchange, get subsidized coverage. That's what would trigger your penalties. And we'll talk about those in a second. So, if nothing else, if you want to take away the very basics of ACA compliance, at the end of the day, if you're an applicable large employer, you need to offer coverage to at least 95% of eligible employees and their dependents. And the coverage that you offer, not necessarily what they take, but the coverage that's offered, the lowest cost qualifying plan when you're looking at the employee only level of coverage, the cost of that, or the employee's share of that, must not exceed 9.83% of their household income. So that percentage is re-indexed every year. It's up slightly from last year, so they always play with that number. There's never been a huge swing. It's usually decimal points of difference, but for this year, the affordability threshold is considered 9.83%. So we'll talk about that a little bit later as well. So as for due dates, so these are the due dates for the 2021 filing year due this year. So in terms of the 1095 forms that you need to give to employees, as I said, historically that's been in alignment with the W-2s, but I've been here in the industry for every year that the ACA has, and they've never held employers to that January 31st deadline. So, as I mentioned earlier, they are permanently moving that. But for this year and going forward, that deadline is extended to March 2nd. And then for the filings that are required with the IRS, if you're a paper filer, your ACA forms are due February 28th. If you're an electronic filer, if you're with us MP, you're considered an electronic filer, the forms are due March 31st. If for some reason you need an extension for any of your ACA filings with the IRS, you'll want to utilize Form 8809. That would provide up to a 30-day extension to file. So if for some reason you're having trouble gathering your information, or heaven forbid you have to do your ACA manually or by hand, if you're doing it out on your own there, you may need an extension. It is a lot of work if you don't have a system helping you. So if so, look up 8809 and that can give you a small extension. All right, so let's talk about the fun stuff. Let's talk about penalties. So the first, there are two main penalties when it comes to the ACA aside from the filing stuff. The first is what's called the non-offer penalty, and this is the biggie. So as I said before, your requirement as an employer, now that all of the relief, this was a kind of a sliding scale for the first few years, but essentially if you fail to offer insurance to at least 95% of your eligible employees, and at least one of those employees receives a subsidy by getting insurance on the exchange, the penalty for that is not just based on that one employee who gets the subsidy. It's based on your entire workforce or your entire FTE count. So from an annual perspective, this is the new number. It was $2,500 and change, but they've ticked it up to $2,700. So basically, your bill or your penalty, if this happens to you, you offered to less than 95% of your workforce, and one of those employees went to the exchange and got a subsidy, the penalty would be $2,700 per FTE minus the first 30 FTEs. So in our example here, looking at a 100 full-time equivalent company, if they were found to be afoul of this rule, you would shave off the first 30 FTEs, so you're left with 70 FTEs, and then you would multiply that by, that 2570 is the previous, but the math is correct. You take the 70 times 2,700, and your penalty would be $189,000. So nothing to sneeze at there, a huge expense. One thing to note is that the penalties are prorated on a monthly basis. So when they're looking at a violation, they look at the months that were affected. So if let's say that employee only worked for you for 6 months and left, or only had that subsidized coverage for 6 months, whatever it may be, in that case, the penalty would be cut in half. It is based on a monthly basis. We're just using the annualized numbers, assuming that the out of compliance status was for all 12 months. The other penalty to be mindful of is known as the Affordability Penalty. So this one is lesser, and it is also only based on number of employees who receive the subsidy. So this would be enacted if you have an employee whose offer of coverage was not considered affordable by any of the safe harbors, which we'll discuss in a moment, and then they go again to the exchange and get subsidized coverage. This number has also ticked up a little bit for this filing year. It's up to $4,060, but again, it would only be counted towards employees receiving a subsidy. So again, going back to our 100 FTE company, if they had 4 full-time employees who were not offered affordable coverage, and those 4 employees got subsidized coverage through the exchange, your penalty would be 4 times the $4,060, or a total penalty of $16,240. So definitely not peanuts, but a lot less than the 6-figure penalty that the company was facing for the non-offer of coverage. Finally, unchanged are the failure to file penalties with the IRS. So if you file late, and again, we'll see what happens with the elimination of good faith, but we like to think that they'll still honor it to some extent when people are trying to do the right thing and file, even if it is after the fact, if they realize they were subject and didn't file, what have you. The late filing penalties can be up to $280 per form, with a maximum of a penalty of $3 million. Because the ACA crosses over a couple different IRS codes, there is the potential that if they wanted to, they could double that fine, because you're technically late filing under two separate IRS codes. So it could potentially be $560 per form. I haven't seen that in practice, but the law allows for it. If they feel that a company was being malicious, willfully violating the law and not complying, an intentional failure to file penalty can be $530 per form. And again, that can also be doubled, and there's no cap when they feel it's been a willful or intentional failure to file. Okay, so with all that talk about penalties, hopefully I haven't struck fear in anyone, but if I have, the natural question is, what do I do if I get a penalty letter? And over the years, I have seen some of them come in. I will let you know the IRS is years behind on these. So I think it was maybe 2019 that we started seeing penalty letters for 2015 and followed similar suit. So if you have an employee who did receive subsidized coverage through the exchange, you could very well get a letter, even if you were fully compliant and did everything you were supposed to. So I think my first piece of advice, if you do get a letter, and it'll be titled form or letter 226J. That's basically what the form is called that you would receive from the IRS in the mail. First piece of advice: don't panic. We've seen these come through, and at least in my experience, while it's a limited sample size, every time we've been successful in responding to these and having whatever proposed penalty was in there wiped away. The IRS doesn't necessarily have all the data that they need to really formulate accuracy. Basically, what they do is they see that subsidy came in, they take a basic look at the makeup of the business and kind of assess an amount. Hopefully this doesn't happen too often, but it is structured in a way where a business might think that that's the amount due. So they might just cut a check and send that back. The 226J does provide the opportunity to just admit wrongdoing and send in the check, send in a payment right away. I advise not doing that. They do alternatively give you the opportunity to respond without sending in a payment, and at least in my experience, that's always been the best way to tackle this. If you are truly out of compliance, they may come back and say that you do owe some money, and that's fine, but it's best to state your case first and allow them to take a look at the facts. So again, first, don't panic, but at the same time, don't procrastinate. We have at times seen that the letters will always have a deadline for a response, and sometimes that window has been relatively brief. So you don't want to procrastinate. Don't let it sit there until your next meeting with your benefits advisor, or your HR team, or whatever it may be. So don't sit on it. You do want to take a look at it, see what it says. It'll name some specific employees. It'll obviously name the year in question. It'll kind of give you a breakdown of what they're coming up with their assessment for a penalty and why. So at that point, you want to take a look. You want to take a look at many things. Honestly, the first thing I would do is run your overall employee information report to see were you even subject for ACA in that year. Because I remember the first one of these that I ever saw was someone that was new to us. We hadn't worked with them before. We didn't have the payroll data in our system, but we were able to go back to the previous provider, pull that payroll information, and come to find out, based on that year that they were being penalized for, they weren't an applicable large employer, so they didn't need to be in compliance. So that was an easy one. They they weren't required to be offering this employee insurance. So they were in the clear there, but each one has its own set of circumstances. So first I would run that check, make sure you were actually subject to the ACA for the year in question. And then, take a look at that employee. Were they considered full-time for you during that period? Were they offered coverage? So that's another one that'll come up sometimes. Someone I talked to the other day had that situation where they received one of these. It was for an employee they offered coverage to. That employee waived coverage. And when an employee does that, assuming that the offer of coverage was affordable to them, they're not eligible for a subsidy through the exchange at that point because they were offered affordable coverage from their employer. So I'm not sure what'll happen if they'll go after that employee, but the employer was found to be in the clear because they were able to show that they had a waiver signed by the employee that they were offered coverage and were declining it. So again, that will come to help you. One quick tip, if I forget to mention it by the end, if you're not now, each open enrollment period for anyone who's declining coverage, do make sure that you're gathering a waiver for them so that in case down the road, because sometimes it can be several years down the road and this employee may be long gone, you'll want to make sure you have that waiver because that will help your case immensely if you have that on file. So you do want to write a response prior to the deadline in the letter. If you're a client of ours, certainly reach out to us. We can help out, help you gather the facts, help you with the response. You just want to answer the questions that they're asking, respond to any claims, especially if you're in disagreement with those, and send that off, and then wait for the ruling. So as long as you're responding within the time frame, you have that period to wait before you have to send in any payment. You don't need to send in payment, at least in any of the letters that I've seen, as you kind of await the response to your response. So write your response, include your evidence and your information in that response, send it off, and then wait to hear what they say. Again, I've personally had a lot of luck with that. We've been able to wash away all the penalties that I've seen assessed. But that's just a little bit a new slide we've added for this year because we don't want anyone to panic, and certainly don't want to send anyone to send in penalties or payments for stuff they don't actually owe. All right, so let's dive into the information reporting requirements. So in terms of legalese here, ACA falls under IRS codes 6055 and 6056. So this is kind of why when you get penalized for non-filing, why it can potentially be doubled. So 6056 requires applicable large employers to provide an annual statement to each full-time employee. That's a 1095. And then code 6055 requires employers provide minimum essential coverage to covered persons. So 6055 generally will fall more on your insurer. If you're a fully insured plan, that the carrier will send out 1095Bs to your employees, and then you're responsible for what's known as 1095C. If you are self-insured, you're going to want to talk to whoever you have that self-insurance through to make sure that all of the necessary ACA filings are being squared away, and that you know what you're responsible for and you know what they're responsible for. So why does the IRS make us do these filings? One of the more frustrating things that we do is an employer or a client will go through all of their 1095Cs, they'll get to know all the codes, they'll make any edits as needed, and then create these forms and distribute them to all the employees, and then they say, okay, what do I tell the employee they need to do with this? And really the answer is nothing. At least at this time, the 1095Cs do not play any role in the individual income tax return or income tax filing. They really just want to keep those on file for their records, but really the forms are to ensure that employees that are eligible for subsidies know that and can use that information when they go for filing for benefits on the exchanges. and that to keep track of any large employers who may not be offering affordable coverage to employees that they should. So a few more definitions here before we roll on to the next section. Minimum essential coverage is defined as the type of coverage that's needed to have to meet requirements on the Affordable Care Act. So if you're working with a broker or an insurance advisor, most insurances that they're going to offer you do provide what's known as minimum essential coverage. If for some reason you had some catastrophic plan, let's say, there's a chance that it may not meet minimum essential coverage. And again, one thing that's important to know, and I'll repeat this often, you can have other plans that employees take advantage of as long as you are offering them the opportunity to sign up for something that offers minimum essential coverage as well as minimum value. You could, for instance, have a catastrophic plan offered to your employees as long as they're also offered something that meets the ACA requirements. When we talk about affordability in that 9.83% mark, you'll notice that it said 9.83% of household income. So as an employer, you don't know what that employee's household income necessarily looks like. They may have another job, they may have a spouse in their household who works, or other household members who have income. So it's impossible as the employer to really know if the coverage is going to be affordable at the end of the day. Because of that, the Affordable Care Act offers 3 different safe harbors for determining affordability that can keep you compliant. The first of which is the W-2 safe harbor. So that's basically looking at box 1 of the employee's W-2. This slide is slightly out of date, but as you'll see, the number ticked up to 9.83%. So you compare box 1 of the W-2 against the monthly employee share of the lowest cost employee-only coverage that you offer, and want to make sure that on a monthly basis, when you divide by 12, that it's not exceeding that 9.83%. If that test doesn't pass, you can then look at the rate of pay safe harbor. So in that instance, you look at their hourly rate of pay, multiply that by $130, and then whatever that number is, you want that number to be within the affordability guidelines, again, for the monthly cost employee share of the employee-only lowest cost option of the plan. If both of those fail, you could also look at what's known as the federal poverty level safe harbor. I will say that this comes up rarely because of the cost of insurance, unless it's being very heavily subsidized by the company. In most cases, it's hard to meet affordability under the federal poverty level safe harbor. All right, so I'm just looking at the questions here, if there's anything I should address before the general Q&A. How do you know if an employee got subsidized coverage from the exchange? If they waive your coverage, can they still do this? Great question. So you wouldn't necessarily know if an employee received coverage on the exchange. If they are waiving coverage, you just want to make sure that you have that in writing. You have a copy of that waiver, because you won't know, and you won't know, sometimes an employee might just not like the insurance that you have. It might not meet their needs. That's fine. They're still welcome to go to the exchange. It's just they have to answer a series of questions when they apply for coverage through the exchange, just to determine whether or not they're eligible for any subsidies. So there is a question about whether or not you are offered affordable coverage from your employer. If they say yes, that's fine. They can still sign up for plans. They just wouldn't be eligible for the subsidy. But it is very tempting for them to click no, because all of a sudden they'll see the prices that they have to pay dramatically decreased. So it happens often that an employee goes to the exchange and they just naturally answer no, or they may not really understand the option, or they might not understand what's considered affordable by legal definition. But if that happens, you could very well get one of those 226J letters we just talked about. But by being able to show that you offered coverage and it was waived, any penalty assessed to you would also be waived. Does the waiver of coverage checkbox in ISOLVE comply with the waiver of coverage requirement? Yes, it should. So you should have a record of that through the open enrollment to show that the employee, you'd see the electronic timestamp that when the employee accessed the open enrollment, that they did waive the coverage and that they did electronically sign. I will say some insurance carriers have their own waiver form that they want used. So if you hear from the carrier, they may want a specific form filled out by the employee. You can never be too cautious with that. So yes, the electronic onboarding in our system does count as a waiver of coverage, but if you want to do something additional, then no harm in doing that. Okay, do you have to declare which safe harbor you are using? A great question, and that'll segue into what we're talking about now. So one thing to keep in mind is that you don't have to use the same affordability safe harbor across the board for all your employees. So if we say, one employee, Maria, her offer was considered affordable because of her W-2 wages, then we can indicate that on her 1095-C. Meanwhile, if Jonathan, if he did not meet affordability based on the W-2 safe harbor, but did meet affordability based on the rate of pay safe harbor, then we can use W-2 for Maria, we can use rate of pay for Jonathan, and that would all be indicated on these 1095-Cs that we're about to talk about. All right, so let's dig in there. So Form 1095-C is used to collect information about applicable large employers and the coverage that they're offering to employees. So the 1095-C is the form that you're going to issue to your full-time employees in March. So part 1 of the 1095-C really just contains the employee's information and then the company's information. So their name, their address, their social security number, and then the information about the business name, the business address, federal employee identification number, so on and so forth. Part 2 is really the nuts and bolts that discloses whether or not they were offered coverage, what the employee's share was, and then either that they were enrolled or if they weren't enrolled, what safe harbor was used to determine eligibility. Part 3 is for covered individuals. So this would really only come into play if you were self-insured. So if you're a self-insured plan, in addition to the employee information, you'd also have to have information about the dependents. But if your plan's fully insured, you just go through a broker and have Tufts or Blue Cross Blue Shield or Aetna or United or whatever it is. This can be blank. So don't be concerned if this is blank, provided you're considered a fully insured plan. Part 3 would only come into play if you're self-insured. Okay, so part 2 again is the nitty-gritty. So we're going to talk about lines 14, 15, and 16. Line 17 is new. That can be blank. That only comes into play if you use what's called an individual coverage HRA or health reimbursement account. So there is a new program called ICRAs or ICRAs. In those setups, an employer basically provides a dollar amount to all eligible employees. Those employees can then get their own health insurance through the exchange, and that is considered acceptable and ACA compliant. There's just the ACA reporting is really funky for it. You have to look at the average cost of certain plans on the exchange to determine affordability, and you have to include the zip code so that you know that where you're basing their affordability off of based on their home zip. So more complicated than we want to dive into in a 1-hour webinar, so we'll skip that piece. But 14, 15, and 16 are really where you want to be focused. So line 14 is what's telling the story of the offer of coverage. So that shows, what did you offer? Did you offer insurance to this employee? Line 15 is generally going to have a dollar amount. That is the cost, again, not of the plan that they're necessarily signed up for, but that plan and the employee-only version of that plan that's considered to meet minimum coverage and minimum value, that they did have a chance to sign up for if they wanted to. They might have signed up for a better plan than that. You don't have to worry about that, even if it's not affordable. It's just that they had the option to sign up for something affordable. And then line 16 essentially tells the story of what they did with that offer. If they signed up for it, you'll see a 2C. If not, it'll go into what, if any, affordability safe harbor was utilized. So line 14 is going to display if they were offered coverage. If you may see it blank on the months. If there was no change to the offer of coverage, so let's say the employee was employed by you and eligible all 12 months, you would just see something entered in that all 12 months column. And these are the applicable codes, and we will make sure everyone has a copy of these slides afterwards. We'll send a recording of the webinar as well as a copy of the slides so you can look at this at your leisure. I know we're running short on time, so I want to make sure we get through all of this, but you will see these codes. A lot of times you'll see a 1A, meaning a qualified offer was made. That's probably the most common that you'll see for employees that were offered coverage would be a 1A. You will also, especially if you have turnover or have growth and new employees, you will see 1H in there many times. 1H means that there wasn't an offer of coverage. That isn't necessarily a bad thing. It can mean that they terminated with you, so after their termination they weren't offered coverage, which is completely fine. You do not have to factor in COBRA, so COBRA does not count. You're not on the hook for that under this, at least, and it does not need to be reflected in your ACA filings. It could also be that someone started, but let's say you have a 60-day waiting period, so those first 2 months after they were hired, 1H would still be correct. They weren't offered coverage during that waiting period. So don't be necessarily afraid if you see 1H on your forms. It just means that they weren't offered coverage, and most likely because they weren't eligible or weren't employed by you. But there's a whole laundry list of potential 1 codes for line 14. So line 15, kind of the meat of the sandwich in the 14, 15, 16 series, is going to show the lowest cost employee-only monthly option. Again, it won't show the full cost of the plan. It'll show the employee share, so what they would have been responsible for. And the IRS uses this to determine eligibility. So this is the number they use. Line 16 is going to show whether or not the employee enrolled in coverage through the employer, and if not, what the affordability safe harbor used was. So for employees who are on the plan, who are enrolled in some plan with you as the employer, if they were on your group health plan in some capacity, the most common code you would see would be 2C. That would just indicate that they were enrolled. At that point, they're not really factoring in affordability. At least for those months, the employee is not going to be on the exchange because they're insured through you. So to answer the previous question that came in, these are generally what you're going to see as the affordability safe harbors on line 16 of the 1095-C for any employees who were not enrolled in the coverage. So if the W-2 safe harbor is being used for that employee, you'd see code 2F. If the rate of pay safe harbor is being utilized, you'd see code 2H. Again, 2G is less common. That's when the federal poverty level safe harbor is being utilized. You're more often going to see 2F and 2H. I can speak for the iSolve system, so if you are an MP client and with us for ACA filing, our system will automatically run all the scenarios, so you'll see this automatically populate. So they'll run through the 3 safe harbors, and whichever one is applicable, if there is one applicable, it'll automatically get plugged in there. If you don't see something on line 16, that should give you pause. It may be indicating that the coverage was not affordable by any of the safe harbors and might require a little bit more inspection. Form 1094C is a close relative to Form 1095C. So 1094s do not need to be distributed to the employees. There's just one of these. There's a 1095C produced for each of your full-time employees. And again, the information on that will differ from employee to employee. 1094C is really a roundup of all of the 1095Cs that are being filed. So 1094 will include all of the information about the business. It'll also indicate whether or not there are other members of a control group. So if you're part of a larger organization, a controlled ownership group, there'll usually be one singular filing for this. But if there are other FEINs being counted, or you're filing other 1095s for other entities within your control group, at that time you'll see those listed in here on the 1094. And then there's a month-by-month breakdown for whether or not you offered minimum essential coverage, and how many 1095Cs are being produced and how many full-time employees you had during those months. So here you see on line 18, this is going to tell you the total number of 1095Cs that you're filing for that year. You just want to make sure that that matches up so that the number of 1095Cs that you're reviewing and be distributing to employees matches the number on the 1094. So if nothing else, really ACA success depends and relies upon maintaining accurate employee records. So you just want to make sure that for employees who are meeting the threshold for being considered full-time, they're being offered coverage, you're tracking whether or not they're signing up for insurance or waiving it, and then monitoring the affordability of those plans throughout the year if you have people who are lower wage especially. So for those of you who are clients of ours, there are a few key reports that really help you determine all of these things. I'll quickly go through these before we open it up to additional questions. The first of which is the large employer test, and this is going to be step one as a business to determine whether or not you have to be worried about any of the stuff we've talked about over the last hour. So this is one of my favorite reports. I use it for a number of applications, but again, you always want to put in the previous calendar year. So if we're looking at 2022 here and saying, really, do I need to be in compliance in 2022? Do I need to be offering insurance to my employees and then filing these 1094s and 1095s in 2023? What you're going to want to do is run this report for 2021. So from 1/1/2021 to 12/31/2021, and see what spits out. So the first line will say your full-time employees. So the number of employees you indicated were full-time, as well as anyone who kind of crossed the hours worked for each month. It'll then add up all of the hours of your less than full-time employees and ultimately come up with an FTE count for each month and then average that over the course of the year. Then finally, you'll want to take a look in this box, and this is your FTE count of record. So in this example here, this employer was considered an applicable large employer because that number was 50 or greater. Another really handy report is this one here, the full-time look-back report. This will tell you, based on your measurement period, and you can play around with it and customize it to your needs, whether or not an employee should be offered coverage. So you'll see some people will be listed as variable, and based on the results and the payroll data, this person, for instance, is considered full-time, so they should be offered coverage. You may also see people who are full-time, they worked full-time hours, no action required. You may see people who are listed as full-time in your system, but based on their hours worked, they didn't really meet the threshold. So come open enrollment time, you may want to check on that, and maybe they won't be eligible for the next go-around. Finally, there's the affordability report. So you can run this. It will take the benefit data and the plan noted as the lowest cost ACA applicable option in the system against the various safe harbors, so W-2, rate of pay, all of that. It'll then help flag anyone who falls below and would not be considered affordable. And what's really handy is it gives you some options and kind of lets you know what you're looking at. So option one is, okay, what would you have to pay employees to get in compliance and have everyone be considered affordable based on their earnings? That's the top number. Second number is how much would you need to subsidize employee benefits so that everyone would be deemed affordable? And then last, hey, if I just let it ride and everyone who's considered not affordable goes on the exchange and gets subsidized coverage, what would that potential penalty be for me? Then that's the third number. So it gives you some options, lets you weigh, and depending on what your comfortability for risk is, would allow you to make some decisions there. And then finally, we are a little bit past the deadline for filing under the ACA, but if you haven't already, you do want to go into ACA forms approval and iSolved. Take a look at those forms. Hopefully this presentation has helped you understand what you're looking at. And then go ahead and approve those. If there is something that needs correction, do reach out to us and talk to us about that. We'd be happy to. All right, so let's see if we have any questions that we can answer here. There is a question about union coverage and eligibility under unions. Those honestly can be quite complex. That might, I'd say my first suggestion would just be talk to the union and how to handle ACA compliance with the union plan. If you run into trouble, do reach out to us. We'd be happy to do a quick consult for you. Let's see what else we have for questions here. I know we've just got a minute or two. Looks like we've answered most of them. What happens if an employee was offered coverage, but they do not respond with enrolling or waiving? If the employer has proof that they were offered coverage, does that help? It does help. It's kind of impossible to say, what the IRS would do if they don't have proof that coverage was waived. It is really a best practice that you be a little militant during your open enrollment period and demand that if anyone's not signing up for coverage, that they do waive, and that they do, they do assertively waive coverage. That it's not just they kind of leave it standing. So I know a lot of employers will make everybody go through open enrollment. So if it's an electronic open enrollment, if they see that people didn't access it, they say, even if you're waiving everything, you need to log in, you need to go through and waive, because it is really important that you do have that waiver if possible. Again, if you can prove the offer, you might be okay, but I can't guarantee it. Can you quickly go over how to manually calculate the FTE count? I have to do these by hand. Sure. So again, anyone who's considered full-time, anyone in a month who had 130 or more hours, you just count as one. Anyone who is under 130 hours, you add up those hours and divide by 130. That's the FTE count for that month. You add those two numbers together, and that's your FTE count for that month. You do that for all 12 months. Add it together and divide by 12, and that's your FTE count for the year. Then one final question before I kick it back and close up shop here. With a 3-month look back period, do we only have to offer coverage for 3 months? Great question. So that is the one exception to the rule. If you're using a 3-month look back period, the stability period has to be at least 6 months. Otherwise, for a 6-month look back, you can use a stability period of 6 months. If you're using 9 months, it can be 9, and 12 months can be 12. The one rule is if you're using a 3-month look back period, anyone who qualifies in those 3 months has to be offered coverage for at least 6. So I think we're out of time. I thank you very much for participation today and kick it back to you.
Thanks, Paul. Lots of valuable information on a complex topic. Any questions that were not able to be answered on today's program will receive a response via email within 5 to 7 business days. The MP HR team is here to help guide your organization on any HR compliance issues. If you would like to learn more about how we can assist your organization, please visit our website to set up a short 15-minute call. Be sure to join us next week on the same day and time for our webinar on unpacking the employee retention credit, funding for businesses impacted by COVID. Visit our website to register and to see the full calendar of upcoming events and available resources. We will be sending out a recording of today's webinar with the presentation slides this afternoon. Thank you for joining us today and have a terrific day.